Hello, this is John Kvale, and this is your October 2015 video, and I'm off-site, so those diligent listeners, you might find it interesting, but this is where where I do the radio show. This is an office off-site, and so I'm out of the office, but I wanted to say hi and thank you in advance for watching the video. And we'll get to the blog post. We've got some really good stuff. It's October. This is actually October 30th, and I'm filming this. So we're just one day. Actually, the end of the month just finished. Here we go. Okay, actually I've put two tax planning techniques in this video. We're nearing the end of the year. On every Wednesday I'm running some special tax planning. These are pretty sophisticated. These are things that we've learned over the past 3 decades, and I wanted to just review them and I can give you a little bit of the verbiage that goes behind what's going on. Okay, clump or push. This is a very neat technique. If you happen to be just under your itemized amount, so you're just doing a simple 1040 and you're paying your property tax, consider clumping those together. So what I mean is putting 2 in the same year, and that may jump you over the itemization. In a funny scenario, if you just every year you were just under your itemized, then you're going to lose some of your tax dollars. You're going to basically not get all of your tax itemization if you would clump. It's totally legal. We're not ever pushing any gray areas. The other thing on this, and I call this the push. If you had a big year and we may have some phase outs, consider pushing those property taxes into the next year. All right, enough on that. These are both posts that I did during the month, but I wanted to talk about them. This is a more complicated technique, but wanted to give it some runway. Should we have a loss? Should you find yourself at a loss? Now, there's different types of income. There's active, passive, and portfolio income, and I talk about it where you can click here on the actual post. But should you have a loss, and you've got to do some accurate estimates, consider doing a Roth conversion. Not all people can contribute to a Roth, but almost everybody can convert an IRA into a Roth agnostically of your age. What that does is that shows income. The goal here is to flatten your loss. So if you had a 50 in the example I did in this post here, so you have a $50,000 loss, you may consider having a Roth conversion for about $50,000 to offset that. This is not, there are some be very careful. There's some downside of this. Do not take this. This is a complicated technique. Do not take this lightly. Don't try and do this yourself, and certainly don't do it just based on this post. Give us a call if you have a question. All right, this is neat. I'm going to try and keep this post short, or this video short. Remember last month? This is right out of last month. I just pulled the same chart. Oh my gosh, we had a 10 for the quarter. For the quarter, we had a 10% move, negative. This is the total world market. And I mentioned here, I'm like, well, it looks kind of silly to just sit here and watch our hard-earned money go and go and go. Well, and I also always talk about never going all in or all out. Look what happened. This is about anywhere between a 6 and an 8% move, depending on what index you're talking about. Yes, this may turn right back around. And it may go flying up. No one knows. We're in a seasonally strong period of time. The point is, in investing, you just don't go all in, you don't go all out. And I really concluded this. This is another reason not to watch this stuff on a monthly or even quarterly time frame. We really ought to talk about it over decades. That's what we're talking about. I mentioned it. Donald and I watched this second by second, but we always step back and realize that the adjustments that we were making we're never going all in or all out. Anyway, hope you enjoyed the video. Hope you have a wonderful fall going, and we'll talk to you after Thanksgiving. Thanks so much. Have a great day.